Good afternoon and welcome. My name's Kevin Igoe, Managing Director of Professional Fee Protection, and I'm delighted today to be introducing Richard Morley as a tax partner in HW Fisher. Now, today's webinar concerns the thorny topic of making disclosures to HMRC, and it's something we get quite a lot of queries about on our tax helplines. Is exactly when do I make a disclosure, how do I make it, and who do I make it to? So Richard, firstly, welcome. If I could ask you to perhaps say hello to our listeners and give a little bit about your background, please.
Thanks very much, Kevin, and good afternoon, everybody. First of all, thank you for listening in. Thank you also to PFP for inviting me to present this webinar to you today. So as Kevin says, yeah, I'm a tax partner with HW Fisher, a top 25 firm based in London. I joined Fisher's earlier this year to set up and develop a dedicated tax investigations and disclosures team. Before I joined Fisher's, I spent just over 20 years with BDO, also in London, and that was part of their tax disputes team. Now, I originally started out working for what was then Inland Revenue back in the late 1980s, which was a fantastic time to be working at the Inland Revenue. And for anybody with my tax office background, I was office number 775, Whittam in Essex. You don't forget these things.
Okay, thanks, Richard. Okay, so as usual, we will be sending around a copy of the slides after the webinar. And also, as usual, if anybody has any questions, please put them in the questions box in the usual manner, and we'll get through as many as you can. Richard has obviously said that the more difficult questions, the better, and he's open to everything. So please do keep them coming in throughout the webinar. So without further ado, Richard, if I hand back to you, and off we go.
Thanks very much, Kevin. So this is what we're going to be looking at today in our webinar on making disclosures to HMRC. I'll be talking for about 40-45 minutes, but as Kevin said, we'll try and answer questions as they come through. So please do feel free to keep sending these through. Now, before we get started with the real body of today's webinar, I thought I'll just share with you what HMRC, officially anyway, have to say about voluntary disclosures. HMRC believes that its customers want to pay the right amount of tax and wants to help those that are not paying the right amount to put that right. And it doesn't matter why your tax affairs are wrong. It's better to come to HMRC and admit any failures or inaccuracies rather than wait until we contact you. Now, I agree with both of these statements. Perhaps I agree with one more than the other, but I thought I would just raise those, and I'll leave those with you as we go through this seminar. So why make a disclosure? I thought I'd put this more memorable one of HMRC's adverts up on the screen. I don't know if you remember this one with the eyes and, you know, we're closing in on undeclared income. It was all a bit Big Brotherish, wasn't it? I mean, we saw these about 9 or 10 years ago. All very daunting. But why make a disclosure? Well, quite simply, as advisors, you know, it's our job, it's our responsibility to make sure that we provide correct advice and prepare returns, for example, tax returns correctly. But this can only ever be based on receiving the correct information in the first place. The onus, as we all know, to ensure that things like tax returns are correct lies with our clients. But mistakes can and inevitably do happen. So as soon as that becomes apparent, either a mistake's been made or an omission has arisen for whatever reason, you know, you should immediately be thinking about a disclosure to HMRC. It's not really so much a question of if, but more a question of how best to, and what is the best disclosure route. I agree with HMRC that it's certainly better to come forward voluntary on a voluntary basis. The alternative is HMRC becoming aware of the matter, and you know that can significantly sort of shift the tactics, if you like. If HMRC become aware of a matter, they'll immediately become sceptical for example, with other parts of your client's return and or other years, if that is relevant. It is, therefore, or at least it should be, easier to manage an irregularity through the process of the voluntary disclosure, as opposed to being caught out and having to deal with a situation on the back foot, as it were. And apart from anything else, making a voluntary disclosure will normally result in far lower penalties, or at the very least, it will put you in a position where an argument for no or lower penalties is more easily capable of being accepted. Plus, it's usually cheaper cost-wise to manage a voluntary disclosure rather than a full inquiry. So, this question, do you have to make a disclosure? Well, I think, the short answer to that is yes, you do. I mean, the alternative simply carries too much risk, and you should be asking yourself, why would you accept that risk? I mean, not only would there be issues with our regulatory position, our professional bodies, not to mention HMRC, could there also be a risk, for example, as being categorised as an enabler under the enabler penalty regime? Now, if you're in a position of having to consider making a disclosure, the best course of action is to agree it with your client, agree to make it on their behalf, regularise their position, and move on. And in terms of facilities, well, it wasn't so long ago we were awash with disclosure facilities, weren't we? Although these were typically aimed at offshore. I remember discussions with clients at the time along the lines of, look, you're telling me to disclose now, but am I better off waiting and seeing if a more attractive disclosure facility will come along that means I'm going to pay less? And of course, the advice at the time was always, no, don't wait, you should disclose now. There won't be a more attractive disclosure facility coming along at a later date. But I always remember, metaphorically, keeping my fingers crossed in the hope that HMRC wouldn't, in fact, release a more attractive disclosure facility at a later date. But those days are largely behind us now. What we currently have available is HMRC's digital disclosure service, and this is pretty much the go-to facility, if you like. And even if you contact HMRC outside of this regarding any disclosure, they'll point you towards using the digital disclosure service in any event. This service, it's simple and it's straightforward, which is good, as long as your disclosure that you're making is itself simple and straightforward. And we'll cover more on this later in the presentation when we look at how you actually make a disclosure. But if your disclosure specifically relates to rental income, there's the Net Property Campaign that's still around, and that can be used. The Net Property Campaign it's merely a derivative of the digital disclosure service anyway. And again, we'll be looking at the Let Property Campaign later in this webinar. If your disclosure relates to anything that relates to an offshore matter, for example, it could be undeclared foreign bank account income, then the Worldwide Disclosure Facility should be used. As with the Let Property Campaign, the Worldwide Disclosure Facility is yet another derivative of the digital disclosure service, but there are a couple of additional risks if you use the WDF, and I'll be highlighting those in a separate slide. The digital disclosure certainly can be used to disclose income tax, capital gains, corporation tax, and national insurance. If you've got a disclosure which includes inheritance tax, and for example, the WDF, which can be used to disclose inheritance tax, is not an option for you, then there's no separate facility for this, and in those circumstances, you'll need to contact the Trust and Estates Risk Team at HMRC. They're based in Nottingham. I've used that. I've done so on many occasions, and I've always found them to be quite helpful. As an example, I once had a situation where I was instructed by UK lawyers by some Australian trustees. For many years, they've been administering and trying to finalise an estate on behalf of an Australian national. part of the deceased estate included UK assets, but there was also a question mark in respect of the domicile status of the deceased, either UK dom or deemed dom. And in which case, if they were UK dom or deemed dom, the entire estate would be subject to UK inheritance tax. So, the difference really was between paying a significant amount of inheritance tax or nothing at all, as the value of the UK assets at the date of death were covered by the Royal Rate Band at the time. So the bottom line was, I got in touch with the trustee and estates team. I offered and we agreed that I would put a report together based on the available information and evidence, and hopefully agree an outcome. And that outcome was, thankfully, the deceased wasn't UK dom or deemed dom, which obviously was a good outcome. But I'm just mentioning that because it was just a good example of how you can approach HMRC with something that's less than straightforward outside of, for example, the digital disclosure service. One important point to note with the DDS, the Let Property campaign, and the Worldwide Disclosure Facility is that none of these disclosure facilities carry any form of indemnity from prosecution. In other words, HMRC can, in theory, take a voluntary disclosure and proceed on a criminal route with a view to prosecution. But we've got to bear in mind here, what is HMRC's general policy regarding not only prosecutions but also voluntary disclosures? What that says is that they do not take the prosecution route where a full and voluntary, a full and complete voluntary disclosure is made. If they started following prosecution routes, then that is going to completely discourage the level of voluntary disclosures that they would start to receive. So thankfully, that is not what they do.
Okay, Richard, if we just come in there with a quick question, if I can, before we carry on. If you could perhaps speak up a little bit more into the mic, I don't really think you turn it up a little bit. Is there a point in making a disclosure if the client simply doesn't have the funds to pay?
Okay, so look, if the client hasn't got any money to pay you, you're going to be undertaking a bit of work on their behalf. I think the answer to that question is if you're still acting for the client and you come across a situation where a disclosure is required, I would always advise you to carry on and make that disclosure, simply because if you're acting for that client, okay, you're going to have to work out costs and fees and discuss that with the client. But for some of the reasons that I mentioned before, you don't want to be in a position where you're still acting for a client, you're in receipt of information which indicated that a disclosure was made and you haven't made it. There are too many risks associated with our professional body's regulatory position, not to mention the enablers legislation, for you to simply say, I'm not going to get paid, therefore I'm not going to do it. So my advice would be, look, make the disclosure and sort out the fee position if you still want to act for the client. If you cease acting for the client, then you don't have to.
Okay, great, thank you.
So just to finish off on this side, so in my experience, the vast majority of disclosures arise as a result of mistakes, oversights, being given wrong information, misinterpreting information, forgetfulness, not being aware of the rules, or occasionally heads being put into sand. But at what stage might you start to think about needing prosecution protection? Now, this really comes into play when you consider and establish the nature of the mistake or omission that requires disclosure, and anything that is likely to be considered as deliberate, or in HMRC speak, fraudulent. This should be considered as a potential risk, and in these circumstances, consideration should then be given to the immunity protection under HMRC's contractual disclosure facility. Which brings us on to the CDF. Now, the CDF contractual disclosure facility, it's really only suitable and to be used on behalf of clients who need to admit to deliberate behaviour. You know, HMRC will always refer to this as tax fraud. So it's quite you know, it's quite something to, you know, for a client to actually admit to this. But you know, it's open for individuals only, and not any other entities. And by filling in the contractual disclosure form CDF1, you can do that online. You can request HMRC to consider your client for a CDF contract. So in other words, a voluntary CDF disclosure. If you decide it's right, your client will sign up to the CDF contract with HMRC. And what that means is that both your client and HMRC agree to stick to the terms of the contract, which broadly speaking are, in return for HMRC agreeing not to criminally investigate your client in turn agrees that they will make an admission that there's been deliberate contact. They'll make a full disclosure to HMRC. They'll give an outline of that disclosure within a 60-day period, and they'll, if necessary, give additional details if it's appropriate in the form of a report following the 60-day period. And a successful CDF disclosure, you know, one of the benefits of making this, it will result in lower penalties. You still have to pay a minimum 20% penalty if the disclosure is fully unprompted, as opposed to a minimum 35% if it's prompted. And this assumes maximum credit, of course, for giving, telling, helping. You've got to beware though. There is potential for what's known as naming and shaming here. If anything other than the maximum abatement is given where a deliberate penalty is involved. Now, if for some reason you voluntarily request the CDF, HMRC accept it, they send out the paperwork, you've then got 60 days to accept the invitation and submit the outline disclosure. Now, if for some reason, excuse me, if your client rejects that, changes their mind, or they just, you know, a reply is not provided within the 60 days, then, well, guess what's going to happen? HMRC will in all likelihood begin their investigation anyway, whether that's on a civil or indeed a criminal basis. The Code of Practice 9, okay, it's been with us for many, many years. This explains how the CDF process works. It's possible, and I've had experience of this, to include sufficient information within an outline disclosure, which needs to be submitted within the 60-day time limit, such that you can potentially avoid the formal meeting stage and report stage. Sometimes they're not required, but usually they are. Now, meetings were dispersed with during the pandemic, and HMRC were very reluctant to hold these virtually. But they are voluntary. You've got to remember that. Now, if either after the outline disclosure and/or, you know, if you're required to attend a meeting or have a follow-up report, if HMRC then have sufficient information to settle matters, then that will be done so via a contractual settlement with the usual letters of offer and certificates of full disclosure and such like. HMRC, they'll always ask for a payment on account at the time the outline disclosure is submitted, and pay something if you can. HMRC will always say that it stops interest running, etc., which it would do. But a more important point here, a payment on account is a good sign of cooperation, which will not go unnoticed, particularly when it comes to the penalty negotiations. And in my experience, and having managed a fair number of voluntary CDF disclosures, the key question here is, what is the best outcome for the client? It's far better, in my view, for a client to hold their hands up and pay a penalty. Again, if it's voluntary, you get full abatement. The minimum is 20% for an unprompted disclosure. But with the immunity from prosecution, than risk having HMRC make up their own minds about it, and in a worst case scenario, then start a criminal investigation. You know, if the disclosure relates to deliberate behaviour, and you know, what is deliberate, that can be a subjective matter, but it is sometimes obvious. If it is obvious, then the clients will pretty much have to be told what they need to do if they want to avoid the risk of prosecution. Recent experiences, recent cases of mine involve both a company and its director. I mean, there simply haven't been any declarations made to HMRC over the last 9-10 years. I mean, that's an obvious case. They need protection under the CDF. But another case involved a client who I'd previously dealt with and requested a voluntary CDF for. Everything was brought up to date, not a problem. But they came back to me because guess what? There'd been a second period of failing to declare anything. Given the history, I mean, it was my sort of decision almost, but I believe that there was a risk of prosecution there, so I requested a voluntary CDF again. HMRC accepted it, and it was all settled. And crucially, in that case, none of the years involved crossed over with any of those settled under the previous settlement. For anything marginal, okay, is it deliberate? Isn't it deliberate? You know, there's always a balance. I understand that. You know, when considering and requesting a voluntary CDF, it's not something to be done lightly. The key question is really, what is the value to the client of the prosecution immunity? There is without doubt additional cost and risk, not just the minimum tax scheme penalty of 20% involved when requesting a voluntary disclosure on the CDF, as opposed to, for example, under the DDS or anything else.
Okay, we've got a couple more questions in, Richard. So, yeah. Concerning the clients, if they're unwilling to disclose, and presumably if the agent resigns, then they've still got to make a money laundering report.
Yes, I mean, I think if particularly if there's anything that, you know, in your view relates to anything that could be construed as deliberate behaviour, but even if it doesn't, I mean, if you want to protect yourself, then you'd submit a sum. So I think that's the way to go.
Okay. Nick's had a client that's just come to him, earns over 250,000 per annum. He hasn't previously registered for self-assessment or submitted a tax return previously. Now he will need to complete a tax return based on his level of income. The question is, can the historic returns be completed via online disclosures for IT, or should self-assessment returns be issued and completed? And is he correct in thinking the individual only has to go back 6 years?
Okay, a couple of questions in that, I think. The first of which I'm actually going to touch on later. And the answer to whether returns need to be submitted for those past years depends on whether HMRC issued any to the client before you took them on. If they did, and I believe the period is from 17-18 only, the revenue will still expect those returns to be completed and submitted. If no returns were issued, you can't complete returns. You have to go via a disclosure facility. And the other question there, do you only go back 6 years? Well, again, that relates to the behaviours, and we're going to touch on that as well. I mean, if the period in question, if the behaviour, if you believe, is nothing worse than careless, then you go back 6 years. Again, it depends whether there's offshore matters involved in there as well. There are now differences in the time periods involved. I'm going to cover that later on as well. But really, the answer to the question is, it depends on the behaviour involved. If it's an obvious, potentially deliberate case, the revenue can go back up to 20 years.
So am I right there, Richard, in saying that if you think it's careless, say, and no more than that, then you would give them the information for 6 years, but you would let them know it did go back further than that, so you're not held to be, you know, should it be held to be deliberate at some later stage, then you can be held to be not cooperating.
Yeah, that's right. I mean, you know, I wouldn't ever do the work for 20 years. I mean, that's crazy. But yeah, to base the disclosure on 6 years, submit your justification as to why you believe it's nothing worse than careless. But yeah, in the interest of making full disclosure, not only protecting yourself but also your client, you can refer to the fact that this has been going on since X year or whatever. But you'd only need to include the relevant income details for 6 years.
Okay, so we've had also a couple of questions on the disclosure itself. Along two lines, most of them. One is, what if the client hasn't done anything deliberate and the disclosure doesn't involve let property or overseas income or trusts and estates? How and why do you, how do you make that disclosure? Is it just to the local tax office? And the other thing is, if you get someone in that same bracket, but he hasn't got a local tax office, as we had with Nick's question, and he doesn't have a tax office you can make a disclosure to.
Okay, so you'd use the digital disclosure service if you haven't got any offshore related, or it's not deliberate or what have you. You'd use the digital disclosure service, and if it was a matter that you believed was what we call innocent error, your client's taken reasonable care or they've got a reasonable excuse, you're only going to go back 4 years anyway. But you'd use the digital disclosure service for that. If in the event that they haven't registered before, that process can be dealt with as part of the disclosure itself. So that would happen at the same time.
Okay, thank you. Is there any downside to putting in a zero penalty when making a disclosure? Now, obviously for COP9, they want a minimum 20%, but outside of that?
Yeah, I mean, under the, either the WDF or DDS, so behaviours are self-assessed, and I'm pretty much jumping the gun on my own content here. We're going to cover this a bit later on, but it's down to you to, as the advisor, to state what you believe the correct penalty category is by reference to the behaviour. And look, there's no real downside in terms of, are there additional penalties, or is there anything that can come back? Are you going to end up in a worse position? That's not the case, but what you're doing really is risking HMRC rejecting your disclosure, because if you're simply putting nil penalties to everything, then HMRC are just going to reject it. What I would do is, if you believe that a nil penalty exists, then I would be inclined to draft and submit a separate letter setting out your explanation and your justification for that. The separate letter can be submitted at the same time as the disclosure, and it actually gives whoever at HMRC is reviewing your disclosure the context on which you are saying nil penalty applies. I mean, if they don't agree with it, okay, there are other ways to deal with that, but just simply submitting a disclosure of itself without a penalty, you're going to get the revenue come back and say you haven't included any penalties here, and they'll reject it. So it's a bit of a
Okay, thank you. HMRC is increasingly claiming failure to notify in cases where the taxpayer didn't get round to sorting things out or didn't understand what they had to do, nothing deliberate. However, HMRC then is trying to get more than 6 years, right back to, for example, the rental income began, claiming failure to notify. If you string them along long enough, they settle for 6 years, but surely this is wrong?
Yeah, I mean, look, the position with failure to notify, and this applies where there's an absence of returns. I mean, if returns have been submitted and they're just wrong, then you're into the territory of failing to take reasonable care or careless and then deliberate. If no returns have been submitted, you've got either a reasonable excuse to justify why their returns have not been submitted. Outside of a reasonable excuse, you've then either got a maximum 20-year period, which is either deliberate or non-deliberate. So look, I mean, if you end up with this sort of quasi 6-year, well, it's kind of careless, I'm not going to say that's strictly right, because I don't think it is. But look, if it's you're going to settle on 6 years rather than potentially 20, so if that's what the revenue offer you, then I'd go for it. But it's not strictly right.
Yeah, okay. I would add here, we had a query in our recent conference we did where somebody had made a disclosure. I think it's probably for you, Richard, more than anything else. He disclosed it and made a deliberate penalty, and the revenue rejected it and said they felt it wasn't deliberate. It was only a failure to take reasonable care, so they didn't want all the tax and the penalties.
Priceless. They don't come along very often, yeah. So make the most of it.
So a new client's come to Ivan saying they need to pay the HMRC the high income child benefit charge. He's omitted it from his tax returns for all years. In essence, how many years does he have to disclose?
So again, I think you've got to look at the behaviour. What was the reason why they weren't previously included on tax returns? If it falls into one of those areas that I referred to earlier, is it just an ignorance of the rules, or they just didn't know, they forgot, they weren't aware, this sort of thing? I mean, look, you can probably say that's nothing worse than careless. If there's any reason, for example, did they take advice, and that advice for whatever reason is you don't need to include that on your returns, they may have a reasonable care argument. But if no advice was taken, they just got it wrong, they just weren't aware, assuming, of course, that they don't tell you, I was fully aware of this, I just decided I just didn't want to pay it, which is obviously in deliberate territory, then it's going to be nothing worse than careless at face value.
Okay. Lastly, before we move on, a question from AD. Is there scope for HMRC to prosecute a client over money laundering following a voluntary disclosure? In other words, does the disclosure bring everything up to date or only the tax side of things?
Yeah, I mean, look, if the activity is criminal in nature, then HMRC can refer that on, and potentially you could be in danger of having further issues around money laundering. So just disclosing it and regularising it for tax purposes is not a be-all and end-all immunity. It's immunity against tax prosecution, but it may not necessarily get you off the hook. I mean, if there are any concerns or considerations, then both you and your client should be taking legal advice.
Okay, great. Right, we've got a fair number of questions coming in, but if we crack on now and get through a few slides, and I'll perhaps ask them a little bit later on. Thanks, Richard.
Yeah, okay, thanks, Kevin. Okay, so picking up on the Let Property campaign. So this is an opportunity for landlords who may owe any tax through the letting out of residential only property, either in the UK or abroad, to regularise their tax position. The scope of the Let Property campaign, it's open to all residential property landlords and includes landlords with multiple property portfolios, single rental landlords, what we call specialist landlords with student or workforce rentals, or anybody with holiday lets. Even if you've got a client whose income from the rent-a-room scheme has exceeded the tax-free threshold. And as I said, it's residential only. So if you've got income that's been undeclared from, say, a shop or an office, then that's not available for the Let Property campaign. It's also not available if you want to disclose rental income on behalf of, let's say, a company or a trust. It's individuals only. Just a quick note here about jointly held property. HMRC will usually tax jointly held property on a 50-50 basis, unless a Form 17 has been completed and submitted. Now, let's give you an example. So you've got a husband and wife, they own a residential property, generates income, and they say to you, look, this has been undeclared for the last 5-6 years. Can we put it all in the name of the partner who either pays no tax, isn't working, or they pay basic rate tax, the other's higher rate taxpayer. Now, unless a Form 17 has been submitted, then it's not going to work. I mean, if the income's been undeclared, you wouldn't have submitted a Form 17 anyway. I mean, by all means, try it, but it's it's not going to work either if you submit Form 17 with the disclosure on the basis that it's always been a 99-1 split. You can try appealing to HMRC's better nature, but don't expect them to have a great deal of sympathy or exercise much discretion. So, I mean, this campaign, the Let Property campaign itself, it's been around for quite some years now, and it doesn't look as if HMRC are going to end it anytime soon. So moving on now to the Worldwide Disclosure Facility, the WDF. I mean, this has been around for a few years now, hasn't it? It opened in 2016, and this needs to be used where a disclosure is required and is in respect of a UK tax liability that relates wholly or partly to an offshore matter. Now, an offshore matter includes anything unpaid or omitted relating to income arising from a non-UK source, if it derives from assets held outside the UK, or from activities carried on outside the UK. And there's a bit of a catch-all, anything that has the effect of being any of the above. So it also includes funds connected to unpaid or omitted UK tax that maybe you've transferred to a country outside of the UK. Let me give you an example. A client of yours comes to you and says, look, I've been receiving UK rental income for the last X number of years. It's undeclared. I've paid it, or I've asked my tenant to pay it directly into an overseas bank account. The undeclared rental income, although it's from a UK source, it will be deemed to be an offshore matter because it was paid into an overseas bank account, and therefore it will need to be disclosed under the Worldwide Disclosure Facility. As I mentioned earlier, there's no guarantee against prosecution if you make a disclosure under the WDF. I've certainly not heard of any cases, I've not come across any that have resulted in criminal prosecution where a disclosure has been made under the WDF, although in saying that, if you recall the Liechtenstein Disclosure Facility, the LDF, there were a very small number of prosecutions that arose following the voluntary disclosures under the LDF. Now the LDF, if you remember that did actually include an implied immunity against prosecution, but the bottom line is you do still have to make a complete and correct disclosure. The relevant factors in those cases which led to prosecution, the clients just simply did not make a correct disclosure in revenue. On my understanding, has to encourage the client, the taxpayer, to make a full disclosure. They refused. So really, prosecution was no option. Another thing sort of connected with the WDF, so over 100 countries now are committing to exchanging bank information automatically under the OECD Common Reporting Standard. This increases tax transparency through the automatic exchange of bank information held by residents of one country who hold an account in another reporting country. The WDF, when this was set up by HMRC, was done so in anticipation of the enormous amount of data that it knew it was going to receive every year as a result of the CRS. In 2018 alone, HMRC had reported that they received something like 3 million on 3 million UK residents, which related to something like 6 million different bank accounts. And that's quite a number. And you can appreciate it would take an extraordinary effort and amount of time, to check and risk assess all of this information. So, in effect, HMRC offered the disclosure facility to encourage people to come forward, but more or less at the same time introduced a far more stringent penalty regime, which is all part and parcel of HMRC's focus on offshore matters. And their focus on offshore started a number of years ago. I don't know if you recall the the Offshore Disclosure Facility, the ODF. I think that was 2007. That really opened up HMRC's eyes, not only to the scale of the problem, but also to how they could go about accessing information from offshore. Now, in recent years, like 2019 was the latest version of the HMRC document, No Safe Havens. This sets out the revenue's policy on targeting and clamping down on what it perceives to be the risk of offshore tax arrangements. It's a policy that broadly encourages correct compliance and helping people get their tax right, but as an incentive, it uses tough and stringent penalties for that purpose. So if anybody deals with non-dom clients, if your non-dom clients have offshore trusts, then without a doubt, HMRC will view those clients as a potential risk. It seems to be working, the offshore focus for the revenue. They gladly promote the fact that they've collected something like $3 billion in additional tax over the last 10 years or so, but I don't know about you. I mean, I recall when the LDF, the Liechtenstein Disclosure Facility, was announced, there were statements around it being capable of collecting up to $7 billion. And then the WDF, when that came out in 2016, that was going to raise another $5 billion. So look, although their initial estimates are overstated, nevertheless, the commitment to offshore tax compliance by HMRC remains quite high. The requirement to correct, let's just mention that this was the revenue's invitation, in inverted commas, to check your offshore tax affairs and to correct these prior to a deadline of the 30th of September 2018. This date, it was deliberately chosen by HMRC to coincide with the date when it started to receive information under the Common Reporting Standard, Overseas Bank Information. And the incentive under the requirement to correct, the incentive to check your tax position and correct it by 30th September 18 was that you could do so under normal penalty rules, as opposed to the far stricter penalty regime that the requirement to correct introduced, which was known as the failure to correct penalties. The failure to correct penalties, they start at 200% of the tax at stake in relation to any offshore non-compliance. That 200%, it can be reduced by the quality of the disclosure down to 100% for a prompted disclosure, which increases to 150% if it's an unprompted disclosure. Now, the failure to correct penalty regime only applies if HMRC is able to raise an assessment to recover tax on 6th of April 17. What that means is that for any tax years up to and including 5th of April 16, the failure to correct penalties potentially apply. And for disclosures involving offshore matters that include subsequent tax years, 16, 17 onwards, these failure to correct penalties do not apply. Existing penalty rules apply. And when you're, or if you're in the position of having to consider penalties, if it's an offshore matter, it's outside of the failure to correct penalty regime, so it's 16, 17 onwards. You'll also need to bear in mind the jurisdiction connected with the offshore matter by referring to HMRC's classification of territories. Now, this is a list of countries which can either multiply or has the result of multiplying any penalty by a factor of 1.5 or 2, depending on the jurisdiction involved. For example, if your disclosure of 16, 17 onwards involves an undeclared bank account in Switzerland, there will be no additional penalty increase because Switzerland is a Category 1 country. If the disclosure involves, say, Monaco or Panama, then any penalty will be doubled because those countries are a Category 3 countries. And just to top it off, HMRC has also introduced extended time limits which increases the assessment time limit for a non-deliberate offshore non-compliance. That time limit has increased to 12 years, and it's increased from the existing time limits of 4 or 6 where it was careless. These extended time limits basically provide HMRC with a lot more time, okay, to scrutinise, to review, to decide whether offshore transactions relate to additional tax. And the extended time limits have effect from 13-14 for careless irregularities and 15-16 for cases where reasonable care is taken. The 12-year time limit, it doesn't apply, or you can get out of the additional time limits if information was received by HMRC from an overseas jurisdiction. So, for example, if information was supplied under CRS, then there's a disclosure relating to that, but also HMRC needs to be reasonably expected to be aware of the tax loss. So that swings back in HMRC's favour. As an example, if you've got a disclosure now or in the next couple of years for a client whose behaviour you consider is innocent, i.e. they took reasonable care, they're likely to feel a bit aggrieved when you tell them, well, look, because it's an offshore matter, the revenue have got up to 12 years. They can go back to 15-16 instead of the usual 4 years if it was a non-offshore related matter. It seems to have an impact. The increase in time limit seems to impact those on whose behaviour is the least serious. Now, I'm sure you've all seen what are commonly referred to as nudge letters from HMRC. We really started to see these, or the more wider use of these, a few years ago, when HMRC started to follow up on CRS information it received relating to overseas bank accounts. More recently, there's press activity about their anticipated use and to target crypto assets. But broadly speaking, nudge letters are used to prompt the taxpayer to review their affairs and, if appropriate, to make a disclosure. If you receive a nudge letter, it doesn't necessarily mean that there's an error or that disclosure is required, but just have a think about how you respond to it, if indeed you do. Just one line, or one thing to mention here, which is if a nudge letter includes the certificate of tax position, then that relates to the time period covered by the certificate of tax position being unlimited. Okay, and what that means is, if you sign that to say nothing's wrong, but HMRC may decide, and they could use that at a future time, if any significant omissions arise from the previous year's return, that could give HMRC cause for further action. Just to run through these now. So how to make a disclosure? Well, the DDS, as I've said before, it's fairly simple, it's straightforward. You need to notify your intention of disclosure. That can be done online. You need to calculate first and then disclose the relevant income and or gains. You make a formal offer, that's part of the online process, and then you pay the tax which is owed. Only details for one client can be included on a disclosure. So if you have a husband and wife who each have undisclosed income, then they'll each need to fill out a separate and complete a separate disclosure. Following notification, HMRC will issue a disclosure reference number as well as a payment reference number. They'll need to be used for the disclosure and for the payment. Please avoid all costs making any payments relating to a disclosure under existing self-assessment accounts, because all trouble breaks loose if that happens. So you get a specific reference number, and any payments should be made relating to disclosure under that. You can make a disclosure for all tax years up to and including 1920. So for that, read anything but the last or the tax year most recently closed. The number of years that needs to be disclosed depends on the type of behaviour. We've talked about behaviours in some of the questions that have come up before. And behaviour, just to remember, not only does that determine how far back the revenue can assess, but also the penalties that they can charge. And all I'd say here is it's key, I think, to assess the penalty, the behaviour and the penalty position on a reasonable basis and within reason, always to your client's benefit. HMRC expects to accept most disclosures. In my experience, they do. A word of warning, I've had experience where some disclosures made under the worldwide disclosure facility were made at the beginning of this year and still nothing. We've had no acceptance. So what do? Do you simply leave it as it is and treat it as accepted? I think there's a bit of risk involved with that. And I would always encourage you to chase up and continue chasing until a specific response is received, which hopefully will be an acceptance. So here are just a few of my observations based on my experience of making disclosures to HMRC. There's always a risk when making a disclosure that the revenue could see it, they could use it as an opportunity to have a further look at your client's affairs. They can't just do this because they feel like it. There has to be justification on their part, but the message here is that there's simply no guarantee that HMRC can or simply accept a disclosure without further checks and, if necessary, inquiries. Unless you specifically request protection against criminal investigation under the voluntary CDF route, there's no protection under the DDS or WDF disclosure routes. Behaviour categorisation, we've covered that in some of the questions already. It can be subjective. There may, of course, be commercial considerations if the tax at stake is not significant. Do please remember that the difference in behaviour categorisation doesn't only have an impact on penalties, but also the tax years available for HMRC to assess. Multiple or successive disclosures, if it's relating to the same client, is an additional risk for HMRC. They do expect that correct compliance procedures are followed going forwards. A disclosure involving deliberate behaviour can risk publication on the naming and shaming, HMRC's online list of serious tax defaulters. Just one last thing. I mean, I've experienced situations where, I'm sure you have too, where a mistake is uncovered and you discuss it with the client and the client automatically blames you for the error. Now, it might be the case, it might not, but nevertheless, a disclosure is still required. As I've said before, it's not a perfect world. Mistakes can and sometimes do happen. If it's an agent error, penalties are usually not charged, which helps any discussions with the client and hopefully has no lasting effect on the relationship. The advice, quite simply, is if you uncover an error, if it is your fault, speak to your client first, but also what your plan of action to remedy the situation is. That normally works. And HMRC is usually more accommodating if they receive a voluntary disclosure, but I'm sure we've all come across instances where we put it down to HMRC intransigence. If you feel your position is right, if you feel your assessment of the behaviour and hence the assessment time limits is correct, if you feel it's supportable and justifiable, if you don't agree with the HMRC officer's decision, you can always have that internally reviewed. That normally unlocks any impasse. And just to finish up, here's the summary with all of this. Make a disclosure if a mistake's been made or omissions realised. It's not a question of if, more a question of how best to. The client's circumstances and nature of the mistake will determine the best disclosure route to follow. If you feel it's right to request a CDF voluntary disclosure, don't then try and back down on the deliberate behaviour when discussing penalties. That doesn't get down too well. Behaviours need to be self-assessed, and remember, it's not only the assessable period, it's the penalties as well. Make a full and complete disclosure. There's no such thing as a partial disclosure. Payment position should always be considered, and if appropriate, a payment plan entered into with HMRC. Just going forwards, just try and ensure that the correct compliance position is followed. And I will just finish by saying that my experience is that HMRC very much welcomes and encourages voluntary disclosures. The vast majority of voluntary disclosures are accepted and submitted without too much hassle or further questioning. And I think the chances of having a disclosure accepted on this basis increase if we take steps to ensure the disclosure is correct and complete and the behaviours are assessed on a reasonable basis. Any further questions?
Yeah, okay. We've got a few concerning the let property. Naresh, in August, registered 2 clients to declare their rental income under the let property campaign. To date, only 1 client has received a case reference. What should he do as the 90-day limit has expired?
Yeah, so make the disclosure for the one where you've got a case reference for, but follow up on the other one where you haven't. I mean, it may well be that something's been lost either in an email or by post, but if you're taking steps and you can show evidence that you're following up, you can never be accused of ignoring something that failed to come through to you.
Okay. Again, on the let property, the disclosure form asks when the letting started. Should there be any additional disclosure?
Again, that comes down to behaviours, determining what the assessable period is. I think we covered in an earlier question that if a letting started in, let's say 1983, but you believe that there is nothing worse than careless behaviour that has resulted in tax loss, you only need to disclose 6 years worth of income from that source. But I would be inclined to refer to the fact that it has been going on from an earlier period. There is a chance that the revenue will simply check the information relating to title with land registry, and if they can see that it's been in your ownership or your client's ownership for a number of years, they're only going to ask the question anyway. So you're probably better off avoiding that obvious follow-up by simply stating what the factual position is. If your assessment of their behaviour is correct, HMRC can't go back any earlier than 6 years for assessment purposes anyway.
Okay, thank you. Would you do a voluntary disclosure under the let property campaign for a new client whose husband has declared all the rental income previously as his, but you've now become aware the property is jointly owned? There would be no difference in the tax payable.
Yeah, so, no, I mean, what this comes down to again, I mean, if the husband's disclosed it all, and if there's no difference in the tax payable, then there's no real point making the disclosure for those earlier periods. You're better off just simply ensuring that the returns from now on are correct and complete, and maybe if you want further protection, you can always white space an explanation on the next return that you submit, and if you set out the factual position and confirm that there's no tax loss anyway, not only have you covered your own position, but you've also put HMRC's minds at rest that there's no tax loss. So that's probably the best way to go about it.
Okay, thank you. If a client owes tax on rental income for 20 years, will the revenue accept only tax for 10 years if he's prepared to settle early?
I can tell you that the answer to that will be no.
Yes.
There's no basis for the revenue to do that. Again, I would look at the behaviour and for that, look at the reasons why there's been a failure to not declare that income to HMRC. If returns have been issued and completed declaring other income, then you're really looking at the revenue's ability to go back more than 6 years if they can prove that it's deliberate. If no returns were to you've got a failure to notify position, which in the absence of a reasonable excuse, which would limit the period to 4 years, you're then looking at either a deliberate or a non-deliberate period, but the revenue can go back 20 years anyway for either of those. So again, I think it's crucial to look at the behaviours.
Okay, do you have to justify the split on Form 17?
No.
No. Okay, I like those sort of answers. If we get a check in the tax return requesting documents and info, in preparing the documents, we now find some other income hasn't been disclosed. Can we update the tax return and tell compliance that this has now been done? So I guess it's the question of how when do you make a disclosure following an inquiry starting?
Yeah, I mean, I would always say, make a disclosure as early as you can, even if you haven't got all the information and facts to hand, just in case something else happens. And then at least you can't be accused of not having made the disclosure. I would always make it at the earliest point you can.
I guess the question that leads on from that, Richard, is should they make the disclosure to the officer that's investigating them, or use one of the facilities?
Yes.
To the officer.
Make it to the officer that's currently undertaking the inquiries. I'll give you an example of that. So a recent voluntary CDF, which I submitted on behalf of a client, there were already ongoing inquiries from counter avoidance into this client's affairs, and it got to the stage where they were threatening Schedule 36 information notices. So as soon as the confirmation and the go-ahead to make the CDF, the voluntary CDF, was received, I simply got in touch with the counter avoidance officer and just explained to them what had happened. And they replied and said, yeah, fair enough, my inquiries would be on hold pending the outcome of the acceptance.
Okay. My client hasn't registered for VAT because he thought only UK sales and not overseas sales needed to be taken into account, whether we've reached the threshold. What's the best way to disclose this to HMRC?
Yeah, there's a different criteria where you've got indirect taxes. I'm not a VAT expert, and I don't pretend to be one, so I don't know the answer to that, and all I know is it's separate.
Right. Well, whoever's asked that question, I don't know whether obviously we've got about 300 of you on. Whoever's asked that question, if you want to give us a call at the helpline, if you're a member firm, you can ask our helpline, and they'll be able to help you with that. Right, if a disclosure is made and all tax penalties and interest are paid, and HMRC have accepted the offer, is the case completely closed? Can HMRC still go back and question those past years?
So yes, the position is closed based on the information that has been disclosed. HMRC have discovery provisions which enable them to, as many people will know, they can go back up to 20 years for deliberate irregularities. But it has to be something completely outside of the matters that were disclosed. So yes, it does give you some protection, but of course if there's something else that can talk to you about or happens, then you're not protected by that, and HMRC have effectively got a 20-year window in which they can do something about it.
Okay. There's a couple of queries over when the time limit, the assessment time limit for failure to correct penalties ended. Was it 5th of April 21?
No. So failure to correct penalties can only apply in respect of tax years up to and including 15-16.
Right. Okay. I hear that nudge letters now don't include the certificate of tax position. Is that right?
Yes, I mean, most of the nudge letters that we saw that related to offshore assets, and these were the ones that the Revenue issued following receipt of the CRS information, most of those included certificates of tax position. I think you'll find that the ones that which are more educational, perhaps in nature, for example, the ones that were sent out to non-DOMs last year, and most probably the ones that we'll see that are issued to holders of crypto assets in the next few weeks, they probably won't have certificates of tax position. because they're more educational. But look, if they don't have a certificate of tax position, then all well and good. You don't have to worry about whether it needs to be completed or not.
Okay, thank you. In what circumstances would you suggest completing a certificate attached to a nudge letter is appropriate, if any?
Yeah, so look, I would, in my experience, I think you're always better submitting a separate letter, actually, rather than committing to anything on a nudge letter that has a certificate of tax position, particularly in circumstances where you believe that full and complete disclosure has already been made via tax returns, rather than signing something, because as I said earlier, the risk with that is that the time period on a certificate of tax position is unlimited. These certificates of tax position, the nudge letters themselves, they're not a statutory form. If you respond with a separate covering letter explaining either that the position is correct and complete as far as you're aware, or indeed that you'll be following up with a disclosure, you'll be following up with a disclosure anyway. Yeah, I would just be careful about responding or putting anything on a certificate of tax position at all.
Okay, thank you. Question from Pam: is there any wiggle room to reduce the WWDF penalty below 100% of the tax for extenuating circumstances?
So this is the failure to correct penalty. If you've got a tax year up to and including 15-16, is there any wiggle room? Then the only defence against the failure to correct penalties is whether your client had a reasonable or something akin to a reasonable excuse for the failure. The criteria is deliberately different and it's more stringent where you've got failure to correct penalties involved. So outside of a reasonable excuse, something like the bank provided you with incorrect information on their annual tax reports, it's the bank's fault. They've admitted it. Here's a separate letter admitting it and everything else. So that will get you out of the failure to correct penalty. But if the failure to correct penalties apply, then there's no wiggle room to reduce that minimum 100% penalty for an unprompted disclosure if it were to apply.
Thank you. Presumably, once a reference number for direct disclosure is obtained, payment on account is worthwhile as soon as the disclosure is submitted? Yes.
And indeed, if payment isn't made at broadly the same time that the disclosure is submitted, then HMRC will more often than not simply reject the disclosure because nothing's been paid. Hence why, if full payment can be made, you should do so at the time the disclosure is submitted. If only partial payment can be made, then pay what you can, but tell HMRC that you can only pay, or your client can only pay X amount, and that you'd like to discuss settlement of the balance under a time to pay arrangement, but once the actual disclosure is accepted.
Okay, thank you. For disclosure a year in time for amendment, what are the pros and cons of an amendment versus a WDF disclosure?
So if you can amend, so if let's say you've got a disclosure that only goes back to, let's say, April 19. So that's the tax year 1920. So you can go back and amend that. Actually, no, sorry, you can only go back and amend 2021 at the moment. So if you've got 1920 and you can't amend that particular tax year, the only way to do it is really under a disclosure facility, unless, as I mentioned before, you're in a position where the revenue issued tax returns and they'll want those returns completed and submitted. That's the only way that you can, for example, do a year 1920 and earlier outside of a disclosure facility.
Okay, I'm aware we've run over now. If I just one last one. Client sold an overseas property in July 19, but was omitted from the 1920 tax return. The tax return isn't amended and an additional sum is due, CGT. Would payment via self-assessment be suitable, or should they await the special notification slip?
I would pay under self-assessment as soon as you can.
Okay.
For a couple of reasons. First, it might avoid the necessity of having to do anything outside of self-assessment, and if the revenue accept the amendment and can see that the payment's already been made, then hopefully nothing further will be said about any penalties.
Yeah. Okay. If HMRC will issue a late 1920 return and therefore that year will not be entered on the disclosure, do you have to add another year onto the disclosure at the beginning?
No, I don't. No, I don't think you do. And you're still looking at your behaviours determining your assessable periods, and the assessable periods will determine when that period starts.
Yeah. Do you know what info is included in the OECD COS?
So it's broadly speaking, it's information which identifies a client, so such as name, address, passport number, that sort of thing. The banking information will typically include balances at the year end, balances at the start of the year, and amounts of income which have been received. So it's fairly explicit and reasonably easy for the receiving jurisdiction to identify who it is that's being reported.
Okay, and if you have a last one, when is it appropriate to go direct to FIS with a disclosure?
So that would be the CDF. Obviously, the Contractual Disclosure Facility COP9 is run, handled, and managed by FIS. You may also have situations where, I mean, unofficially, you can make a voluntary COP8, a non-fraudulent disclosure. But as I said right at the start of the presentation, HMRC are more and more encouraging you and directing you to use the DDS route. If it is something that's fairly complex and fairly involved, then the DDS may not be appropriate. There may be, if you've got a corporate, if there's a relationship manager, or indeed if you've got a high net worth individual who's part of the high net worth team, it's always something that you can always discuss with them in the first place. Either way, whether you're registering to make a disclosure or whether you're talking to somebody about it, that's the point at which the notification stage, if you like, has been ticked.
Okay, great. Okay, well, thank you very much, Richard. I think we'll call it a day there. Can I thank everybody for listening in today? This is one of our monthly webinars for our member firms and guests. We had a lot of questions today, hence we've gone over, but Richard's very kindly answered everything we put to him. So, Richard, if you'd like to say your goodbyes.
Thank you very much for listening, and thank you, Kevin, again for the opportunity to speak to your audience today. Thank you.
It was a pleasure. Thank you very much indeed. Lastly, we will be sending a copy of the recording of this webinar out and the slides if anybody wants to listen to them. Indeed, we'll be sending them out if you don't want to listen to them. But thank you again, and we hope to speak to you all again next month. Thanks so much, and thanks again, Richard. Bye-bye.
Bye-bye.